Hi folks, Jay Blanchard here with the Financial Guys, and I've got another market update for you, my clients, and please feel free to share this with friends and family. I know a lot of you have been doing that, and actually I really appreciate it. It gets our name out, and I know a lot of other advisors aren't updating their clients. And this is not the only source of update. Of course, the Financial Guys have updates, especially in increased market volatility, quite often. So you can also go to the Financial Guys website and subscribe to that. These will continue to come through your email. So how are we going to prevail through a declining stock market? Well, let's get into it. Declines have been common, yet temporary occurrences. And I know this is hard to take when you get your statements and they go down and then they go down again and then they go down some more and then, World War III is trying to break out in Europe. It's hard. It's hard emotionally. But history has shown that the stock market declines are a natural part of investing. I've shared with all of you many times that graph from 1925 out till now, and there's plenty of downs, but the market historically has always come back. I mean, it could be the end of the world, but I don't think it is, and I don't think it's the end of the stock market. I think eventually the stock market's going to go back up. The bottom line is we have to accept these declines as a normal part of the investment cycle. Declines can cause imprudent behavior by investors, having a feeling of dread and panic. Okay? The solution is to realize that the declines are inevitable, right? Like if you're going to be in the stock market, you're going to take declines. This decline is not any different than any of the others that have happened in the past. It has different facets, but even I feel like this is an overdue correction, and it's a good one. It's going to flush things out, and it's going to help companies that adapt take the stock market to the next level. The key here, historically speaking, the declines have not lasted forever. In fact, they've only lasted for limited amounts of years. Well, what is the smart money doing? I think Warren Buffett's pretty smart. The market, he says, is the most efficient mechanism anywhere in the world for the transfer of wealth from impatient people to patient people. Now, we have to identify who's the impatient and who is the patient. And guess what Warren Buffett is doing right now? He's buying stocks. You can see this in the Wall Street Journal. It was on Market Watch. It's been on CNBC. He's buying. I am encouraging clients that have new money to buy. Why? You want to buy when it's scary. Am I calling this the bottom of the market? No, I can't do that. But I think 2 years from now, stocks will be up. So I think this is a good time to buy. You have to play this disciplined. You cannot play it emotional. When stock markets drop, you need to be a buyer. When they go up, you then be a seller. That's what we want to try and do. Proper perspective can help you remain calm. The problem: studies show that people place too much emphasis on recent events and disregard long-term realities. Even amid market downturn, remember that stocks have always rewarded us over time. And these graphs, I'm not going to get into them too much, but these downs seem crazy bad, but guess what? It always comes back. Average annual returns for 10 years ending 12/31/21, 17%. Now, you're not in if you're with me, there's a super good chance you don't have all stocks. You're not going to achieve that rate of return. But it is, backfilling the fact that if you stay invested, the market has come back every time. And this graph goes from December 37 to December 21. Fairly recent graph. I am very, very, very much against timing the market. I have had a few. Everybody asks me, Do you get a lot of calls when this is going on? I don't. I mean, since January, I think I might have gotten 7 total phone calls from worried clients. And if you're one of those clients, I welcome that call. But I think I do a really good job of educating, and that's why I don't get many calls. And I do a good job of communicating when the market's down. Problem: research has shown that losses feel twice as bad as gains feel good. So that's a problem, right? Because I hardly ever, and I got great clients. You're all great clients, but very seldom do clients call and say, "Wow, my portfolio is going up. Thank you so much. It's incredible. What a great month. I loved opening my." They don't do that, and I don't want you to do that. I mean, a hug when you come in, I like that, but you don't have to call me when markets are up. That's my job to watch your stuff, right? But the pain is greater compared to an equal. The pain on the loss is greater than the endorphins on the gain when the market's going up. So you have to know that and then guard against that. And I am not immune to this. And that's why when you come in, generally my TV is on, volume off, because I don't want to hear the noise. I don't want to go home depressed from all that negative news. Keep in mind that fleeing the market to reduce losses when could remain losing out on gains when stocks recover. Well, why is that? You don't know when to get back in. And look at these. So these are big declines up here, folks. 32, 42, 74, 02, and 09, 86% drop, 60% drop, 48, 49, 56. These are big drops. But what happens after that? You get some big gains. The problem is trying to figure out when. No, we don't do that. We're long-term investors here. And I love this saying. I love it because I think it really communicates the essence of where our focus should be. Time, not timing, is what matters. Time, not timing, is what matters. Trying to avoid risk could itself be risky, since it's impossible to know when to get back in. And here's some examples. An investor managed to pick the very best day, the market low of each year to invest. The average annual return on that investment would have been 9%, 9.16. The other investor was not so lucky and picked the worst day. Even the worst investment timing, the average annual return would have been 6.9. At the end of 20 years, the cumulative investment of $200K had that value of $415,560. Riding it out. Hypothetical investors didn't pull out of the market but stayed the course for 20 years. That perseverance helped improve the client's chances that they could come out ahead. History has shown positive outcomes occur much more often over longer periods than shorter ones. And over the past 91 years, right, we've had, depending on how you cut it, almost 100 years of stock market history. The S&P has gone up and down each year. 27% of those years had negative results, right? So it's, 70, almost 75% positive and 25, /7% negative. That's the way it rolls. But the up years are bigger and longer than the down years. The best in the worst of times. The more missed best days, the steeper the loss. So I love this slide. This says here, Fred and Wilma Flintstone had $1,000 originally invested, okay, in the S&P excluding dividends from 09 to 18. Invested the entire period, $2,700. Here's the jeopardy. If you miss the 10 best days, you lose $1,000. And I do have a few people that have gone to cash. And they ask me, will you market time me back in? No, I won't. I'll call you, but I cannot time that market. That is not a skill set I have. And quite frankly, I've studied this over and over and over again. And I've studied different investment managers, and none of them have been able to time. Now, our portfolio managers are being proactive. In some cases, they're building up some cash, looking for value buys, but we don't believe in market timing. If you miss the 20 best days, your $2,700 return goes down to $1,200 and on down the line. So there's a risk in going to cash, and people don't realize this. There's a big risk. My experience with people that go to cash, they don't do near as well as investors that stay invested. And that's not just my experience. I've read a multitude of mutual fund studies that have taken a sample size much larger than my client book, and the results are exactly the same there. And almost, I got to think I've showed this slide to all of you. It's one we've rebalanced, and I will restate again. We're not market timers, but our discipline has led to some pretty decent luck. Those little diamonds on this slide show you where we've rebalanced. On the climbing markets, we're selling stocks to bonds and cash. And then, like, if you look at here, the big, I don't have my cursor going, but, well, I don't know if you can see this because of the way the production's made, but in 2020, right before COVID, there's a big climb right in the middle of this slide, this graph, and COVID breaks out, and woo, down we go. Scary. And again, we weren't calling the bottom of that market, but we did a disciplined rebal at almost the perfect time, and we continue to do this. In fact, 2 weeks ago, I believe, it might have been 2 or 3, but we rebalanced. Well, the 1 week we rebalanced mutual fund portfolios, and next week we balanced ETF portfolios. And if you're watching, if you have individual stocks with me, you see the investment managers making changes in those accounts with disciplined strategies and systematic buys and sells based on the investment philosophy for that particular stock portfolio that you're in. All right, that's it. This one's short and sweet. I just wanted to give you a little juice, decrease the panic. Things are going to be all right. We're going to come out of this just fine. You're scared, call me. I love hearing from you. I never discourage the calls. Share this with friends and family. If you have anything, let me know. Anybody you want me to follow up with, we love you all. You're extended family to us. And, I'll probably see most of you this summer, but enjoy this absolutely gorgeous weather that we're having right now. The reason we all live in Western New York are these great summers. So that's it for me on a Friday. Thank you very much, and have a unbelievably great weekend. And don't worry about your portfolio.